How can a financial planner protect you from making financial mistakes as a new real estate investor? Maybe you're wondering, do I have enough of a nest egg in the bank to protect me against the inevitable bumps in the road that comes with real estate investing? Or maybe before you even get started, you would like to talk to a financial advisor, but they're only talking to you about buying your first home. When you start talking about investing, you get a blank stare, or worse yet, you get somebody who's trying to talk you out of getting more involved with real estate investing. In today's video, I'm going to talk to you about how having a financial planner who is knowledgeable about real estate investing can help you achieve more of your overall personal financial goals. Now, these could be goals to achieve more financial freedom today or to create more generational wealth that you could pass on to the next generation. Imagine not second guessing yourself about how you're running the numbers on that deal that's in front of you that your realtor that you love thinks is a no-brainer. Now, if you can get into that first deal more quickly, that means that you'll be on to the second deal and even further along the path of achieving real financial results for yourself. And it all comes down to your overall financial plan. And when I'm talking about a financial plan for real estate investing, it goes beyond checking your savings account balance and filling out a loan application. Now, if you're really serious about using real estate to build a scalable portfolio to diversify your income so that you can become, one of my favorite phrases, work optional earlier, or just set yourself up for long-term success, you need a solid financial plan. So let's get started. I'm Veronica Woods, and welcome to the Real Estate Wisdom channel, where we provide market updates about Philadelphia and suburban Delaware County real estate, as well as provide tips about how to keep a more profitable rental property portfolio. If you want to get in contact with me or anybody from my team, I have multiple ways to contact me. They're below this video. You can even schedule a time to chat on Zoom. But let's jump right into my interview with my friend Cynthia Meyer, who's also a certified financial planner and owner of Real Life Planning. We're going to get into how you can get value out of talking to a financial planner about your financial readiness to take on a rental property portfolio for the long haul. So I'm so happy to have you on my podcast, the Real Estate Wisdom channel today. I know we're always collaborating either on other clients. Of course, we're talking about content for our Rental Property Cafe podcast, which you definitely, for my viewers, if you haven't checked it out, this is the time to check it out. But I'm just so excited to talk to you with my audience. So Cynthia, you're famous in my eyes, but if you could start off by just telling everyone a little bit about yourself.
Well, thanks, Veronica. Thanks for having me on your channel. As always, you're one of my favorite people to talk to about all things real estate and all things finance. So I think this is going to be a really interesting conversation. So I've like to call myself a financial mentor. I'm a financial planner who works with real estate investors. And I also teach other financial planners how to work with real estate investors. So in my firm, Real Life Planning, we do financial planning for people who own rental properties and vacation properties. Not so much on the commercial real estate side, but more on the residential side. And in my other business, Real Estate Financial Coach, I offer continuing education to financial planners and accounting professionals for working with real estate investors. And the reason that I say financial mentor is because, as you know, as a real estate owner, real estate may be treated passively on the income tax return, but it's business, right? Owning rental properties is a lot like owning a small business. And we have to approach it that way, right? And it's entrepreneurial. And people want coaching. They don't just want a financial planner to come in and say, okay, do this, do that, do the other thing. Or real estate investors are generally pretty DIY crowd, right? And they want to have a resource to talk through all those big financial decisions.
Yeah, that's obviously a lot to it in terms of what you need in a financial planner support in order to be a good real estate investor. And, maybe touch on, why you think the financial plan should go beyond just looking at your bank account. I have this amount it saves and let me get a loan. Because a lot of the people I talk to as a real estate broker, and I ask the question, have you talked to a financial planner about your journey or your goals in real estate investing? They don't think of even doing that because they think, oh, I know I have this amount of money in the bank and I know I'm going to get a loan. So if you could just touch on why there's a lot more to it than that.
Sure. Well, the first thing I'll say is that up until recently, most financial planners were and financial planning professionals and other types of financial advisors who are not credentialed financial planners that just aren't talking to real estate investors. Or unfortunately, when they do talk to real estate investors, they try and talk them out of owning real estate. So real estate investors are just walking away from those engagements. I mean, you wouldn't, when you think about it, right, you wouldn't tell somebody that owned gas stations, like my grandfather owned a Texaco station. Like you wouldn't tell somebody like that to sell their gas station and put their money in stocks and mutual funds, right? So, so financial planners have, up until recently, and we've really been trying to change this, have gotten a bad rap, right, with the real estate investor client. Think of, the real estate is how a family might build wealth, right? But there are still all those other moving parts about maintaining the wealth in a tax efficient manner. And I know that word wealth is kind of, like it's overused right now. So builds security, build financial independence, maybe is a better way to think about it. So I like to say that, real estate investors, as they're building and scaling their real estate portfolios, are looking for, should touch on different areas. I mean, the first is risk management, right? And we've talked about this a lot on our Rental Property Cafe podcast, right? Is you have these large illiquid assets. It's hard to value them until you sell them. So figuring out, they have carrying costs. So figuring out how much you're going to keep in cash reserves, what kind of insurance do you need, what's your legal structure, etc. There are a lot of issues around planning issues around leverage, right? What is an appropriate amount of leverage to take when you're buying a new property? When should you refinance a property? Lots of changes in that lately because of changes in interest rates. How does real estate fit into the retirement projection? Many retirement calculators that you can use in your 401k plan or with a financial planner don't really include real estate in an accurate way. Right. So running a retirement projection that is going to help you figure out, especially if you move into that retirement stage where you're living off your doors, is what does that really look like over time with inflation and taxes? Many real estate investors, especially if they just do real estate, right, they're not super diversified, right, is making sure that people have sources of what I like to call consistent income, which are things like rent and Social Security or pension, if you have one, and flexible income, right? And generally flexible income is going to come from securities. It's not going to come from your real estate. So thinking about diversification in this way. How does real estate impact college planning, estate planning, right? What happens to your stuff when you pass away? Do your kids want to take over your real estate business? And contingency planning, right? If you can't If you're managing your own doors and something happens to you, what happens to your tenants, for example, right? Like who are they going to talk to? So then the most important thing is taxes, right? Working with real estate investors is a really tax-focused engagement. There are ways that a lot of DIY investors get themselves in trouble because they take tax advice from Facebook and the internet instead of talking to an accountant. So there are lots of areas that an investor can talk to financial planner about without necessarily, having to choose, okay, I'm going to do real estate or securities.
Yeah, now you definitely covered a lot there. And I do want to put you did a great blog post, which kind of covered a lot of the things that you touched on just now in more detail. So I'm definitely going to put a link to that below the video, wherever you're watching. But I think it kind of comes to the point that people don't really like talking about finances. And even in real estate, even though real estate is a financial asset, people would rather talk about, paint colors and flooring than the actual business and financial part of it. So I think that's why a lot of times people don't necessarily think to include a financial advisor as part of the dream team. And when you're real estate investing. And I was just thinking in your intro, you didn't mention that you are a real estate investor.
Oh, well, that is true. So the reason that I founded these businesses is because I've been a financial planner for a long time, but during the Great Recession, my husband and we started buying rental properties. We were first generation real estate investors, unlike you and your family, right? So we were doing it for the first time, and we started buying single family homes. And then we bought small multifamily. And then a couple of years ago, we started doing some 1031 exchanges to increase our number of doors. And we got our first small apartment complex. So really, I just wanted to pay it forward, right? And find that fusion of financial planning and in real estate investing that I just felt was missing in the financial planning conversation.
Right. And I still think you're somewhat of a unicorn. And I think we are getting to the point where maybe there's more people financial advisors who at least realize they don't know enough about real estate investing to fully advise or coach or mentor. Because I know advising is a sensitive word, but they know that they would recommend their clients seek out other counsel to make sure they're fully vetting their real estate portion of their assets. But I guess, a question top of mind that I'm hearing is, is it still even a good time to invest in real estate? Everybody's afraid about, what's been going on in the housing market. It seems to have kind of shifted. That's the cute word we use in the real estate industry in 2023. So what would you tell someone who's asking, like, is it a good time to be a real estate investor right now?
Well, as a general perspective, I think that for those people who are interested in building a real estate portfolio or real estate business, that it's always a good time. There are always opportunities. People always need places to live. We currently have a shortage of housing in the United States. There's a gap, depending on who's counting, whether they're counting it conservatively or more aggressively. There's a gap of somewhere between 4 and 8 million households that want to buy a home, and they don't have homes available for people to buy right now. And of course, you know this. I'm saying the obvious to you because you see this every day in your work. And so people need places to live. Like that's the way it goes. So the other thing is that as an asset class, if you're doing the right things as a landlord and you're consistently raising the rent in small amounts over time to keep pace with inflation, right? Real estate, it can be an inflation correlated asset, right? It can increase in value, and the rental income can increase in value to keep up with the changes in the cost of living. So I would say it's certainly a little harder to
Yeah.
find a good cash flowing deal now than it was when my husband Steve and I got started in the Great Recession, right? Where if you had cash, you could go, just go look on the internet and you'd find, some pretty interesting deals. To look a little harder, but they're available in all sorts of markets, and even in markets where the rent to price ratio isn't really that favorable, right? Like for somebody who does their homework, there are always deals available.
Yeah. And I
Um,
guess the other
yeah,
thing is not necessarily, or I agree, it's a little harder, but it also kind of, we're like shaking out the
yeah,
good, the more
mm,
expert is kind of rising to the top, because there, quite honestly, there was a period where you could throw a rock and make a
yep,
profit
mm,
as a real estate investor, and everybody's
mm,
calling himself a real estate investor guru.
mm,
And it's
yeah,
really hard for people to figure out, like, how easy
mm,
is this, and
mm,
just because it's harder, does it mean you don't do it, or does it mean
mm,
you do it smarter and you do it more cautious and carefully?
yeah. One of the things that is so helpful when people are doing this for the first time is to find an investor friendly real estate agent like yourself who understands how to evaluate a deal, who knows how to run numbers and can coach somebody, right? That it's uh I'm just amazed every week when I do discovery calls with the new potential clients, and sometimes people will run ideas by me and they'll be losing money from day one, right? So I think there's a lot of, even with this enormous explosion of information about how to be an effective real estate investor, and great organizations like Bigger Pockets, right, who are providing such great content out there for no cost, basically. Uh, there's still a lot of confusion about what makes a successful real estate investment, and uh, it's this is a large amount of money in a liquid investment, as we know, and people should really get their ducks in a row before they buy the first one.
Oh, that's a good point. And you kind of segued into the next question I wanted to ask, which is, I know it's a loaded question, but it's a question I get all the time when they,
Uh,
like you said, if somebody's running the numbers and they wonder, are these numbers good enough? Should
yeah.
it, what are my expectations in terms
Mm,
of figuring out what is a good deal? So
mm,
how do you help people kind of answer that kind of sniff test when you have a deal in front of you, like what's good
yeah.
enough,
Yeah.
kind of move.
So, so I think that's a great question, especially in this interest rate environment. So just as some background, I have a particular point of view about rental property investing, and I realize that not everybody shares this point of view, right? So, in my opinion, the primary reason to invest in rental property, right, is to earn net rents. So, ideally, when you take into account potential vacancy and reserves for capital expenses and all the other expenses of the property, the property should be cash flow positive, even if it's only a small amount to start with, right? So a lot of times people get into real estate and they maybe they're in a highly appreciating market, sort of think Miami or San Francisco area, et cetera, right? And they think, oh, it's okay if I lose money every month because when I sell that property, it's going to have gone up, 50% or something. And I think that is a really dangerous way to approach, to be an appreciation first investor when you are not experienced in that kind of transaction can lose people a lot of money. So the first is, it can be a positive long-term play if you're starting off with even just a small amount of net cash flow every month, as long as it's not losing money, right? Because over time, right, if you run that business well, you're going to be, you're going to refinance that mortgage when rates are lower, and you're going to be consistently, raising rents, right? When you have vacancies, or maybe consistently, if you have a long-term tenant that you want to keep in there, and you're going to consistently keep pace with inflation that way. And so if you start at a good point, right, then the future can only look better.
Right. Now, what you didn't say is you have to do a home run every month. So I think that's where some of my clients are like, I'm gonna do all this effort. And when you only focus on a small cash flow in a month, sometimes it's discouraging of all this effort setting up the balance sheet, which I tell them, but you got to look at what's on your balance sheet with the equity that you're building. People kind of forget about that when
right, they're paying down their mortgage principal. Yeah,
exactly.
Yeah, it's a really good point, Veronica. And and that ties into with all the risk management questions, right? Is that just like for your own home, right? You need an emergency fund for your rental properties or your vacation property, right? That you consistently, you want to be putting some of that rent money away every month for non-regular expenses, right? Like, let's say a tree falls down and you have to clear it up, right? Or the washing machine breaks. And for bigger capital improvements, right? Like, let's say you have to replace the roof in 10 years or whatever. So that's part of the budgeting thing. Now, that's something you're such a numbers person, right? Like, you're coaching your clients to do that really well. But I think there's a lot of people that don't, they've got an agent who says, oh, well, the rent will cover the mortgage, taxes, and insurance. Like, what about all those other expenses?
And that's, quite frankly, that's where I see a lot of people get in trouble. And especially newer real estate investors are so focused on getting the property, getting in the door, and they haven't really thought about a plan for ongoing maintenance if something happens. So what kind of coaching do you give to your clients about kind of preparing for the long haul, not just preparing to get to the closing?
Right. And so for all the clients that we work with on the consumer side at Real Life Planning, is, we're doing an initial financial assessment, right? Where we're going to go through all the moving parts of their financial life, right? So we see how real estate fits into their overall strategy, and make sure that there's coaching to on those areas of real estate operations, right? So cash management and insurance, and setting up your books and things like that. I would say that the biggest risks for the real estate investor, and I wonder if you agree with this or not, I think they're in the first property, right? The largest concentration of risk is in the first property, especially if it's a single family home, because you could get a tenant in there for some reason who doesn't pay, or maybe have a long vacancy for other reasons, and you're stuck with this extra mortgage and all these extra expenses before you have cash flow coming in from other units, right? And so really focused on the person who's just getting started for the first time to make sure they have a strong financial foundation. Maybe looking at something like house hacking, which we've talked about before on our podcast. It as a great way to to get started both as a homeowner and a real estate investor at the same time.
Right. And at the same time, I think you have more options. So there's you can spread out the risk, and you have more options when you have even a small portfolio of 4 or 5 properties of what you can do in terms of from a financial funding perspective. You're looking at the value of the portfolio, and we can get into different loan options and that kind of thing, or just you can make sounder decisions if one property is vacant and the other 4 are cash flowing. You can make better decisions. All right, it's easier. People are more relaxed about the decisions that you need to make. I think. Yeah. And there will always be vacancies at some point in your real estate investing career, right? Like we have 2 single family homes that went vacant at the same time at really inopportune times. Like for some reason, like the tenants extended and then they left in the winter. Our properties are in a different state that's cold in the winter. Just don't want to move in the middle of the winter.
And they'd had long-term tenants and they needed some work in between before we, got the next tenant in there. Right. And so we had vacancy with like 6 months of vacancies in both of those properties. Right. And because we have alternative sources of cash flow within the real estate business, it wasn't a problem. Right. I mean, of course, everybody loves it when they have 100% occupancy. Right. But stuff like this is normal.
Right. Right. I mean, I think the important thing is that you want to continue to make rational financial decisions, not out of desperation, because that's when mistakes happen. I did want to touch on, you mentioned earlier about leverage, and I saw on your famous blog post of that's probably one of the biggest mistakes you see people make is over leveraging, and I would agree that's in my top 5 list of mistakes that people make, because everybody wants to listen to the gurus talking about using other people's money. That's the way you do it. But $500,000 assets, none of my own money. And what would you say, or just warn people against over leveraging?
Sure. Well, so leverage is taking some kind of loan or financing. Could be a traditional mortgage, could be an off-market mortgage. I mean, off-market loan, like a hard money loan, right? And using that to buy a larger property. Right? I think there's a lot of confusion among new real estate investors about what it actually means to do a BRRRR situation, right? Buy, rent, rehab, rent, refinance, repeat, right? That the original concept, right, as it was articulated, is to buy a property for cash, renovate it, then refinance it with a market rate mortgage and go buy the next property for cash, right? And people, because we had this like super low interest rate environment and we had a rising appreciation in property values, people were refinancing their existing property at the same or a lower rate and taking the surplus and putting it as a down payment on a new property. And that was working well for a while until interest rates started going up. And now where what is the average mortgage rate, Veronica? Like 7 right now, 7.5?
I know, depending on when you're watching right now, oscillating between 6 and 7.
Yeah. And so it gets a lot harder to take, let's say, in that second scenario, right, where people were just they bought a property with a mortgage and then they're thinking about taking equity out of that property by refinancing the mortgage. That's a different kind of strategy than what the BRRRR strategy was originally meant to do. And now, what are you going to do? Take your 3.5% mortgage and refinance it at 7%? Like that could, for many people, that immediately turns their next project into negative cash flow. Right? And so it's so important to run the numbers. I would say also that as somebody builds and scales, obviously leverage is an important part of scaling more quickly. It's pretty hard to buy an apartment building without a mortgage, right? Not a lot of people have all that cash hanging around. But having a target leverage ratio that somebody maintains over time so that you don't have too much capital tied up in one property, right? That's a risk management tool. But you also don't have so much loan on the books that if there were a really negative economic period, you couldn't still pay those bills.
Well, I guess the other thing is people think about, well, they'll get an 80% loan here and then I'll borrow the other,
good point.
say 15% over
but
here.
Then you're 100% leveraged.
Right. And they're thinking, oh, I'm not really over leveraged, but you can quickly even on the front end, if you really don't have cash, for the down payment, or you're not buying at enough a deep a discount. So that, I think the point that you made about looking at the overall target ratio, I think that's what a lot of people lose sight of. They're just trying, like, how can I get the money to get in? Back to the thing about focus of acquisition. But if that even after repair value has you at too high of a ratio, there's a lot of bad things that could happen. You could have trouble paying your monthly debt service. You could have trouble selling the property if you had to, with the cost of the exit cost.
Right, you might have to bring cash to closing if you sold it.
Exactly. So, that's what I think people just don't understand about, the consequences. As you can get the money to buy the property, but then what kind of financial situation will you be post-purchase?
That's why you have to, in that situation, as you mentioned, the investor has to run the numbers and see, okay, well, let's say I've taken some home equity from my personal residence, for example, and maybe that's at 8% or 9% in today's rates, and I'm using that for the down payment on an investment property, and then I'm taking it, a regular, conventional loan for the other 75%, for example. You have to include both loans in your calculation of whether it's profitable or not. And that could really get sticky, right? If, let's say, somebody lost their job, right, and there was a big vacancy in the target property at the same time, that could send somebody, leverage amplifies returns, but it also amplifies risk.
And this is an area, really, if somebody didn't have like a financial planner advising type resource on their team, when you're making decisions around, taking money at this rate and this rate and adding it together. Because most of the time the lenders have blinders on. They just worried about getting their money back. So the fact that you kind of stretch too much on loan number 3, they don't care about as much until you default, and then they have to, maybe even take the property. But a lot of times people just aren't holistically looking at the financial picture of their lending decisions.
Yeah, and I think, I'm curious as to what you think about this, Veronica, that, I find that in general, in all my years as a financial planner since the mid-1990s, is that when things are going well, in general, people think they're always going to go well, right? So they think, what real estate has been a wonderful high, has been a wonderful high, performing asset for investors in residential rentals, right? People think that's always going to go well. Well, it is possible that it won't always go well. There will be a period where you might be lowering your rent, or the rents are staying the same. They're not keeping pace with inflation. It could be there are demographic changes in the area in which you're invested, right? And then all of a sudden, there isn't as much demand for your units or whatever, and that could cause prices to fall. It could be something else that happens, right, that causes a property value to fall and not go up, right? Like the nothing goes up in a straight line, right? There's always risk in real estate investing, or any investing, right? Same thing. I saw the same thing, like before the .com bust, right? In the late 1990s and early 2000, is that people just thought stuff just went up forever, right? And it doesn't work that way.
And you can't just set it and forget it. I think that's the other thing. Maybe it's a little easier to do it with your 401k. You go in, you look at, maybe you don't want to look at anything that's going on.
Hopefully you don't look at it too much, right? Yeah, you got a good allocation. You just let it keep.
But real estate, it's really a little bit more of an active business that you may need to tweak, either you or have a team around you of experts that could kind of keep their eye on different changes to alert you that you need to make tweaks in your process.
And interestingly, I'm seeing this a lot with clients that I have in different parts of the country with short-term rentals.
Hmm.
So there's an over, it looks like in this economic environment, there's an oversupply of short-term rentals.
Hmm.
And people are realizing that, just leaving their business to the Airbnb algorithm, right, is not going to be sufficient in the long run to keep their place filled. And starting to notice that, oh wow, yeah, I have to get in there. I have to create a brand around my short-term rental. I have to create a customer or a guest experience, excuse me. I have to find a way to capture emails so I can create my own list. I have to have my own website, all those things like that folks weren't really thinking about 2 years ago.
No, that's a good point. Just wondering. I know we've covered a lot, and we could keep you on for the rest of the day. But
Yeah.
um, besides the short-term rentals, or any other, do you have any other words of wisdom from the approach of a financial
Hmm.
mentor for the new investors that are listening? What else could someone like you advise them on that maybe
Hmm.
they weren't even thinking about, that they should be thinking about as a real estate investor?
Sure, sure. So I think the decision for potential real estate investor or anybody who's considering making a large investment in, maybe they want to buy a business for another type of business, for example, or start another type of business, is uh, that financial planning is your life expressed in numbers, right? So a good financial planner is going to coach you through the process of making wiser, more confident financial decisions that help you get your life goals, right? Help you achieve your life goals. And so thinking about financial planning as a process, right, which is going to help you evaluate the various decision paths that you have in front of you, right? Make sure that you're going to keep as much of what you made as possible, and that you're you've got eyes wide open as to the next steps that you're going to take, right? Like, both the risks and the challenges as well as the potential benefits, I think. I like to think of a good financial planner as somebody who is there to be kind of a wise second opinion, right, about what you're ultimately trying to build for yourself.
Thanks, Cynthia, for imparting your knowledge or wisdom with my audience. I'll have that link to that article below the video. And again, thanks for your time today.
As always, Veronica, thank you for this conversation.
Before we wrap up, I do want to reemphasize a point that Cynthia and I made about where the biggest risk is when it comes to most people's rental property investing career. It's really in that first property. Because when you first buy a property, let's say it's vacant, the expenses don't stop because the tenant didn't move in there. And a lot of times, newer investors start to second guess, are they financially ready during that time? It is a reality that you are funding those expenses out of your own pocket, maybe even your own personal budget if you don't have enough reserves. So that is a reality. The good news that we covered is once you get over that hump of the first property, you do have other or more options as you get on to your second, third, or even fourth property. And most importantly, it's important to make rational decisions during that time. You don't want to kind of freak out because you are under greater risk and make poor decisions. Because after all, you need to think about the long game of building a profitable rental property business. Now, speaking of making decisions about your broader rental property business and operations, you'll want to watch the video that's appearing on the screen now when we talk about how you should weigh the trade-offs between managing your rental properties on your own versus hiring a professional property manager. As always, thanks for watching and happy investing.